What's up, guys? Welcome back to another episode of Behind the Facade. In today's episode, I am speaking with UK property developer and podcast host Rod Turner. Now, apart from being the host of the Rodcast, his own popular UK property podcast, Rod is also the person responsible for getting me into this podcasting lark. And yes, that's right. Back in March of 2020, about 18 months ago, I was over in London to speak at Brendan Quinn's Commercial Property Summit. And Rod reached out to me and asked if I could spare a little bit of time to sit down with him and do a podcast. And I was very happy to do that, sat down with him and enjoyed the experience enough and got kind of interested and curious enough in it that I actually decided that within a month, the lockdown actually kicked off, and as a lockdown project, I thought, let's see what I could do with my own podcast. So anyway, the rest is history. That is not the reason I brought Rod on today. No, it's actually Rod's less well-known activities around investing and developing property in the UK that I wanted to kind of drill into. Now, as you're going to see pretty quickly from this discussion with Rod, he is one of those people who does like to geek out on the financial and economic sort of details of a deal, and then indeed best practice within the industry, whether it's diversification or all of that kind of analytical stuff. And so we get into a good bit of that. And what I found particularly interesting is the analysis that himself and I should mention, Rod is in a couple of ventures with another guest of the show, Adam Lawrence. And Adam appeared back in episode 48 talking about all the apartment buildings that he had bought. But the two of them have bought a property together, and Rod goes into the detail and some of the kind of the behind the scenes analysis and the deal structuring and what they did to make that actual deal work for them. And so it's quite interesting, and I think you're going to get some good value from today's episode. So without further ado, let us jump into my conversation with Mr. Rod Turner. You are listening to Behind the Facade. I'm your host, Gavin J. Gallagher, and on this podcast, I explore the mental and emotional game often playing out subconsciously both in your mind and the mind of everyone else in the real estate or property investment market. The key to success in this game is to master your mindset and behavior, to take control of your thoughts, your emotions, and most importantly, your ego. Welcome to the show. Rod Turner, you're most welcome to Behind the Facade. How are you doing today?
Very well, thank you. Thanks for having me on.
It's good to have you on. I appreciate that you are used to being in front of a microphone, but normally you're the one asking the questions. So we're going to turn the table on you today. And to put you on the spot, just to begin, can you give us your 30-second elevator pitch? Who is Rod Turner and what do you do?
Okay, so funnily enough, I'm very unpolished when it comes to all this stuff about me. But I guess I own a property investment company. I'm passionate about investment. With a basis in real estate and real assets. So I like things that you can touch and hold, and property for me is just a fantastic thing, and I'll probably go into that later. And I like to look at where we can make money from and get good returns with as little risk and as little effort, because I'm a lazy git, as possible. And sometimes it works and sometimes it doesn't. and I guess it's a real broad range of stuff that we do. Yeah.
Good stuff. And in the process of being a lazy guy, you've started a podcast, and I can tell you that it's not always lazy to start a podcast. So
I learned the hard way, unfortunately.
Yeah, the Rodcast. We'll go into some of that today, but just for the purpose of giving the audience some context, let's just take it back to kind of your early years, kind of leaving school and going into college and stuff like that. You haven't approached the property business the way a lot of people would, like through trades or professionally. Tell us about your sort of entry into the market.
Sure. Well, I mean, I guess it's probably, you mentioned kind of through trades or professionally, there's a third option which a lot of other people fall into it, which is kind of getting that property bug, buying a property, normally their own home, doing it up and kind of realizing a profit and going, oh, okay, that worked well. And I guess that's kind of how I fell into it. I bought, I think it was a 1-bed flat that we then converted into a 3-bed flat. as my own home. Did everything wrong, bodged everything, nothing worked. Had my mates living with me as I did it, and afterwards we actually, I'd made a small profit, and I thought, God, with everything that went wrong, and I still came out pretty well. Let's give that another go. And I did it really to the point until HMRC was writing me letters saying this is now a business despite it being your own home, and thought, well, yeah, it probably is now. So that kind of gave me a bit of a push to go into it more on a business level. There's only so many times you can kind of upsize your own home, and especially if you've got kind of wife and kids and things like that.
I can relate.
Starts to become a bit difficult. And so kind of moved into doing developments, smaller scale developments, obviously, to start. Kind of just grew organically, really. So doing your typical kind of house to flats, and then conversions from commercial buildings, then into kind of new build stuff, and that kind of, as we went along, built some great partnerships, started doing some more exciting things involving modular housing, involving kind of mental health housing, a bit more specific. I've always had kind of a good brain around finance, really, and started to really understand sort of securitizing income and how powerful that could be, and some of the things that could be done around that, and the ways in which to add value to property, not just from kind of physical, creating kind of increasing the square footage for more pounds per square foot or more euros per square foot, compared to how much it costs you to get there, but also things like structuring leases in a specific way, changing use classes.
Being resourceful.
Yeah, just kind of understanding that property is about location, use class, and tenant type, and how you can, and tenancy type as well, and how you can kind of structure all those different things in different ways to add value. And
it's not always clear straight off the bat.
No, it's not. And it's about kind of, I guess, having a really open mind when you go into a deal. And a lot of people kind of, when I speak to them, complain that there's no deals around and things like that. And how do you get deals? They've got to be off market and all this stuff. And I'd say the majority of things that I end up getting is on market, but I'm looking at it for something that it's not being marketed as.
Outside the box thinking.
Yeah, and I think that's where you can often kind of you can often pick something up worthwhile, really. So yeah, that's kind of the background into property. Before kind of property, I ran a security company. Had that for about 13 years. For the last 5 years of that, I mean, my time was 5% on that and 95% on property, and so they kind of built in tandem, really.
Is that because the profits from the security business went into creating a portfolio, or was it just?
Do you know what? It probably was more about what I enjoyed and was passionate about. I never really liked the security business, if I'm honest. I wasn't passionate about it at all, but it
paid the bills.
Yeah, it was a bit of a cash cow. It was very stressful. And property, there's something just so satisfying about seeing a property in the flesh that is not in use or not useful and not particularly nice, and turning it into something that is useful and is appreciated by people. Sounds cheesy, but that's kind of the passionate element that I can really get excited about. Don't get me wrong, it's not easy, it's incredibly stressful, but the feeling of satisfaction that you get from, or I get from that, is just massive. And that's what kind of drives me to do it. I mean, even this morning I was in a design meeting at a site, and it's like it gets my juices flowing, kind of just looking at it and thinking, oh, great. I've never particularly been a creative kind of person. I know you've got a background in architecture, and I'm good at kind of looking at spaces and kind of imagining what it can be. But in terms of like design, things like that, I'm nowhere where I should be in those terms. But yeah, that's I guess what I get out of it. But I never held a property. I mean, as an investment, it was always development. I always wanted to sell, never wanted to deal with tenants. Until
Is that still the case today?
No. So that changed in around 2014. And the reason that changed was really down to the market I was operating in. So I'm based in London. prior to kind of 2014, 2015, it was, like I said, buy and sell developments in London, kind of normally.
It was a hot time as well in the market, wasn't it?
Yeah, well, and that's the reason. And it got to that point, and it was just, I was struggling to justify pricing. I was struggling to kind of look at that second exit. It was reminders of 2008 were coming in terms of kind of how things were being priced. Did I want to take extra risk? And I just thought, do you know what? Rental stress tests changed at that point as well, which really probably had the biggest impact actually on my decision making, because suddenly it went from, okay, now it's extremely difficult. If we can't sell units, what are we going to do? How are we going to refinance? And the number one priority was, how am I going to pay off my senior debt, or my debt that's charged against the asset? How am I going to do that as these rental stress tests have changed, and we're in London where kind of yields were fairly low? And so that just forced me to kind of go, do you know what? I've got to change my priority here in terms of looking at the exits, and now putting kind of first place exit on how can I refinance to pay off my senior debt rather than sell. And that kind of led me to other locations, because
outside of London.
Yeah. So I had three choices really in my mind. It was, okay, I've got a skill set, because everything I do, I'm looking at, right, what's my skill set? What's my edge over the market? If we talk about investment, you're talking about, right, how to get alpha over the market, because otherwise, what's the point? Just go and stick it in a REIT or a fund. And I was kind of, I looked at it as, right, okay, I've got that edge. My edge is, I suppose, in the operation, getting the deal done. The development side of things I was okay at. The location wise, I knew the locations very well that I was operating, so that was an edge. And I thought, right, I can either change use classes, like what I'm doing. I was doing a lot of residential at the time. I can change locations, or I can change kind of the end user tenant type. And I thought about all those things, and I explored first kind of what can I do in terms of changing the tenant type. And that's where I suppose kind of a lot of the securitizing income sort of plays and asset management plays started to come in, and started looking at actually kind of forward funding models and what we could do for. Back then it was kind of, we were very specific about mental health housing. I mean, it falls under kind of the whole social housing brand. But it was looking at that. How could we get kind of the end user contract signed up, and then we could build to order really.
Yeah, de-risk.
Yeah, exactly. So that was one way. The other way was moving locations to where actually rental stress tests wouldn't affect that issue, because yields were a bit higher. So right. I kind of made the choice, okay, let's start looking out of London. And where I wanted to look for, I always look for capital growth, because I'm a developer. Well, at that time I was a developer. Development is incredibly risky, and there's all sorts of unknowns that come along during a development that are out of your control. And so I want a buffer. I want that capital growth buffer. And there's lots of people that always kind of say, no one's got a crystal ball. No one knows about capital growth. And kind of my response to that is, you're in the investment game. If you're unable to forecast, then what are you doing here? I mean, no one's going to kind of arrest you for getting it wrong, but you have to take a view.
Yeah, you're going to come up with a hypothesis at the outset.
Absolutely. And my kind of route to this was, we were looking at residential stuff, and it was always based around, okay, house prices based on affordability, not the typical stuff that kind of the papers all print about, kind of, I don't know, your earnings are X times house prices, because really affordability isn't based on that so much these days, because first time buyers buy with large mortgages. So it's more around kind of interest rates. It's more around what percentage of people's earnings go on mortgage servicing. So length of a mortgage is a huge one. So you can get 40-year mortgage, whereas, I don't know, 30 years ago, 20 was the norm.
Yeah.
So that's spreading the cost, and that creates a massive difference. So I kind of looked at one where I felt was affordable, and had room for growth in the affordability metrics, and two, where I felt the average household kind of income was going to go up, because obviously that affects affordability. And for that, we were looking at, right, where's demographics of kind of young professionals, where are they going to be moving to, where are their salaries going to be moving to, where are kind of jobs coming out of London where those salaries are going to be the same, possibly higher than other regions, and those jobs moving to other regions, where's there a lot of infrastructure projects going on that's going to create kind of more jobs and more incomes, and that kind of led me to Manchester.
Right.
Or more specifically, Salford Quays, where you had kind of the BBC had announced a big move and things like that. So started heading up there to look at kind of doing what I was doing down here, which was building kind of, I don't know, small SME kind of development schemes. And I went up and had a look and quickly kind of realised that actually I had zero edge up there compared to everyone else. I didn't know location really well. I couldn't build as cheap as a lot of the developers up there. And really, like, the build costs were a big factor because capital values were lower than London, but my build costs were really coming in not that far off from what I was paying in London. And so I thought, right, I can't really do new builds up here. It's not going to work for me at this point in time. So the focus kind of went more onto conversions, and started doing a few of those to hold. And then it was kind of a bit of that in Leeds, moved down to East Midlands, and it was kind of it was following the market where I felt there was going to be some benefits of that market kind of capital appreciation to buffer all the mistakes that I would inevitably make. And
I think that's a key thing to kind of recognize in yourself. Is a lot of people, they kind of they have this rosy tinted glasses on, and they kind of think that, oh, this is going to be great, I'm going to do brilliantly. But as I learned in 2008, to my kind of to the pain and suffering that I went through, it's like there are times when the market just catches you off guard. And how do you sort of prepare? I mean, you kind of, it seems that you've already accepted that you're going to make mistakes. Do you do anything in particular to kind of prepare or hedge your bets just in case you've got your hypothesis wrong?
Yeah, I mean, that's a really good question. So I will always factor that my hypothesis is wrong, I think, from the outset. And it's looking at, right, what is out of my control here? So things that are out of my control, planning, okay, I can't justify timeframes in that. Labour and material costs increasing. So from a development point of view, there's three main factors that you've got to do kind of a sensitivity analysis on. And that's your market price going up or down when at the time when you're going to sell or refinance. It's the build costs going up or down, and it's the time frame increasing or decreasing, which inevitably affects the build cost as well. Or finance costs at least anyway. So all of those things really are kind of outside your control. You can mitigate them to a point with really good planning and kind of design and kind of being organized in terms of build schedules, in terms of getting watertight contracts and that sort of stuff. But at the end of the day, that's the industry we're in development in the UK, and it's tricky.
That's why we get paid the big bucks. Yeah.
Well, you'd hope, yeah. because it's a form of investment. It comes down to, right, you're chasing returns, okay, and if you want those big returns, then one of two things or two of two things is normally going to have to be sort of factored in, and one is risk, and the other is effort. Yeah. So if you want to keep increasing those returns, are you willing to increase the amount of risk you're going to take on, i.e., in our case, probably that's debt? And are you willing to increase the amount of effort you're going to put in terms of these are direct investments we're making?
Yeah.
We are our own asset allocators, our own asset managers, really to a point where it's on us. So how much work are we going to do? Are we in control of all those moving parts that we can be in terms of kind of design, operations, marketing at the end value, analysis of the market that we're going into, all these kind of things that probably you don't ever think about when you go into a development. But these are the things now that I do look at in order to try and kind of mitigate those problems. And you talked about kind of doing things to hedge against it. And I think this all comes down to kind of, I'm going to be really boring here and talk about risk and kind of what we do to mitigate those. So in terms of risk from a theory point of view, I guess you can talk about three main things to mitigate, or ways in which to mitigate risk. You can talk about diversifying, and that's looking at things that are uncorrelated to what you've already got. You can talk about hedging, which is going into things that are negatively correlated to what you've already got. So that's things that, I don't know, if one asset price moves up, the other goes down in a proportional way. And then the third is insuring. So you're not stopping the risk from happening. All you're doing is passing kind of the responsibility or the cost of that onto someone else for a premium. And I guess it's just what I tend to do is I look at what we've got, and rather than going, I'm going to diversify, hedge, or insure, what I first look at is what's the risk that I'm concerned about. And I think this is where some people go wrong. They just look at the asset and go, actually, this asset normally moves in a particular way, therefore I'm going to choose to diversify, hedge, or insure. What I tend to do now is I look at, right, what are the risks that I'm concerned about? What are these particular risks? So it might be, again, I'm going to use really sort of terminology like idiosyncratic risks. Are they asset specific? So I don't know, if you've got two houses on Acacia Avenue and one has a pain in the arse tenant in it, then that's going to be an idiosyncratic risk that's specific to that asset. So, right, just by buying another one, you're going to diversify, you're going to reduce risk, because the risk is not kind of industry wide. It's not on residential, it's not location, it's not tenant
specific to that asset and that tenant. Yeah.
And then you've got systemic and systematic. They use these great words that sound exactly the same for two very different things, which is always helpful. And it's looking, right, what are the risks I'm concerned about? So I don't know, it could be interest rates going up. Okay, right, how's that going to affect what I've got at the moment, my portfolio? And is diversifying the best way? And if I'm diversifying, I need to be diversifying to other assets that are not going to move in the same way when affected by an interest rate rise. So by diversifying through, I don't know, FTSE 250 shares, equities, is probably not the best thing to do. And it's probably not really diversifying, because they're correlated in the same way that in which interest rates are going to affect them. So it's thinking, right, let's first identify the risk we're concerned about, and then let's identify how we can actually do something that's not going to be affected by that risk, or it could be hedging and is going to be negatively affected or positively affected by that risk in the opposite way to my portfolio, or obviously insuring. And
is there many, but like, just using that example, I mean, because nowadays it seems that every portfolio manager out there and everyone who has some capital of their own is thinking about this kind of stuff and is starting to diversify. And so if you take a look at the entire market, pretty much everyone is investing in the same sort of bunch of assets. And so therefore, if there is some sort of event happening over here, it will negatively correlate with everything.
It depends is the answer. So, I mean, you could say, right, what's going to be, and look, it's all well and good us saying this stuff, but it's inevitably going to be the risks that we have never thought about that comes to bite us in the backside. So, I mean, you look at what effects might a pandemic have?
Yeah. Well, nobody saw the house price rises the way they have. It's quite insane. Yeah.
Exactly. So it's what assets are going to go up and down with that. Interest rate rises. Okay, what assets are going to go up and down with that? It's understanding like not all these assets will move in the same way. In the same way, you can take one asset class and look at those specific kind of assets and be like, which ones are going to move? If you take equities, for example, you're still going to have ones that will move in different directions depending on what happens. So I think, and this is kind of where I constantly have arguments with IFAs about property, who kind of have this preconceived idea about property, and it's just such a broad market. I mean, you talk about, when you talk about the property market, are you talking about residential houses in prime London, or are you talking about logistic sheds kind of in the middle of Britain? Like they're two different markets, and they operate in very different ways. And they're like you can look at offices regionally, how they've been affected versus prime offices. And you would have thought, right, prime offices in central London would not have come out of this pandemic well, yet they are trading on the lowest yields they've ever traded on.
Yeah, it is hard to kind of understand the thinking, but it does seem like we're in this kind of growing kind of bubble insofar as, 2008 came along out of nowhere. Nobody saw it coming, really. I mean, you could predict in 2007 that something bad was coming, but nobody saw it in 2006, we'll say. And yet it happened, and we all paid a big price for it. Now that we've been, more than 10 years kind of looking at asset prices rising and stuff, you start to kind of wonder, at what stage does it turn? Like, is it going to turn? Are you in any way expecting some kind of a turn? It's funny, I had this back and forth over LinkedIn with Adam and Adam Lawrence, who was on this podcast as well, by the way, after I'd heard him speaking on your podcast. So Adam is very, gets right into the detail, and he seems to think that, residential is going to continue going very strongly. And I think he's probably right. But do you see some sort of a hand grenade coming into the market that, at some point in the near future?
I mean, residential is very much affected by affordability. And if you look at kind of what can affect that affordability, you're looking at really two things. You're looking at wages, and then you're looking at servicing the debt. So wages going up, we are starting to see that. Servicing the debt, I mean, interest rates are likely to go up. When? Probably sooner than we thought 6 months ago now. But how's that going to affect mortgage rates that are not necessarily just based on base rates? They're based on swap rates. And actually, we're starting to see, even though there's a lot of expectations on base rates increasing fairly soon, we're still seeing mortgage rates reducing. As the kind of, they're chasing that. There's a lot of capital in the world at the moment.
Chasing.
And it's chasing yield. And actually, for those banks and lenders, if they're borrowing even at 1% and lending at 1.5%, that's a healthy margin if you've got a couple of billion quid getting lent out. Yeah. So I don't think it's going to be kind of like a straight line going up that way. I think there's going to be a bit of volatility, but I also think you've got different markets everywhere. So, I mean, we can talk about the UK as a whole, but like, even if you look at what I don't think it is, I don't think there's a bubble at the moment. If you look at kind of prime London, which I can't remember the exact stats, but I think it's something like makes up of 18% of the value of residential property in the UK, okay, is in, I think it's 3 boroughs in London, which is just insane. But if you look at kind of those markets, they're down since 2014.
Yeah.
That's sort of 7 years they've actually been going down and down. So that's the opposite of a bubble. They've been moving downwards and in real terms even further. So there's an argument actually when you start comparing those to other assets that you could compare to historically. I don't know, you could UK bonds, other different types of fixed income. Actually, they seem quite cheap in those terms. So it is hard to look at. I think when we look at it, you've got to be quite specific. I think if you're thinking, are interest rates going to go up, going to affect things?
There's definitely inflationary pressure.
Oh yeah. I think they will affect things, but I think the real key question is, will wages and the proportion of wages going up keep up with that in terms of what the servicing costs are for a mortgage? And I think the answer is they will, but not at the same time. So I think what you'll find is that you might get some interest rate rises that will create a bit of a shock to the system, and then wages will start to catch up, and then it will shoot up, and then you might get that interest rate rise again, and it will kind of happen. So it'll be in kind of peaks and troughs, but I do think the direction of travel will continue, probably not at the speed that it has for the last kind of year. I don't know, it was about 8% kind of growth in the UK last year. I don't think it's going to go at that. Yeah, but I do think it's going to be an upward trajectory, whether that's, I don't know, 2 or 3%. People will say, well, that's not even keeping up with inflation. No, but if you look at people's equity and how that will grow, that will keep up with inflation. I mean, if for example you've got a 75% mortgage, and the growth is 2%, then the growth on your equity is actually 8%. So I think in those terms it will. The other things to look at in terms of kind of how will there be shocks in 2008, like the different markets acted very differently. So London acted very differently to, say, Northumberland. And that's really about the values and the amount of equity that's held within those properties. Often in the market, the pace of which the housing market goes is centered around sort of first-time buyers coming into the market. But we can't forget existing homeowners. And I mean, 30% of properties in the UK are owned without a mortgage. So
30%, wow. That's an interesting stat, yeah.
It's quite a lot, and it's actually bigger in London, where values are higher, which is also interesting. And
this is the baby boomers, I guess.
Yeah, exactly. And so there's going to be a shift of that wealth kind of coming down to people. So it's going to be interesting seeing how different kind of parts of the country react to some of these shocks that come along.
You mentioned something earlier before we started recording about running a bowling alley, and you were saying, so you clearly you're prepared to roll up your sleeves and get involved in the operational side of things. So can you just talk a little bit on that? I mean, just to make an asset work, you're prepared to get in and actually run the place.
Yeah, I mean, as I said, kind of if you want the better returns, you've got to be prepared to increase risk or effort. In my view. Unless you're incredibly fortunate, which I'm not. So I think that was the case. It was like the opportunity came up to buy a large kind of commercial mixed-use site that had several different kind of moving parts. So it's got business park on it. It's got a entertainment centre with bowling alley, sports hall, soft play, that kind of stuff. And so we looked at purchasing that, and this was really kind of an asset management play. Actually, I own it with Adam Lawrence, who you had on the podcast you mentioned. Yeah, so we got this along with another partner called Ross Harper, and we looked at this. Initially, it was brought to me as a development opportunity, but I didn't really feel it worked, and actually felt it worked better as an investment. And really, we looked at how can we increase the value of really the income, because that's what it's all about. It's the reliability of those future incomes we can get from the asset, and everything kind of comes back to that. And it was okay. We saw that things were being underutilized, underlet. They weren't being managed particularly well, so that was a great one. And then,
whereabouts is that located?
In the East Midlands, in Derbyshire.
Right.
And so we kind of thought, right, that's a great opportunity for a value add in quite a short space of time. We can get in there, we can run it slightly differently to increase the income coming there. And the other thing that just really appealed was, what's the barrier to entry of other people doing this? And we were buying it below what its reinstatement costs would be. And so really that was quite a driving factor in our decision to go ahead with it, because we were looking for someone else to come and take customers from what we were doing. They would have to build something up because there wasn't anything like that in the area, and the cost of building it would really
take all the benefit away. Yeah.
So we were comfortable that we had decent market share, and it was really just about improving our net operating income, really. And we did that through structuring leases differently, through very simple stuff. I mean, we had the business centre was, I think the market rate for rents was something like £30, £35 a square foot. And these rents that we had people in there that had been there for 7 years and never had kind of their rent put up. And they were paying kind of £12 a square foot. So it was like, there was huge margin in that kind of hadn't been looked at. And simple stuff, just like giving everything a lick of paint and new carpets didn't cost the world, but the difference you got back in rent was huge.
And that multiplier then on the valuation, yeah.
Absolutely. And then structuring the leases differently. So where we had, 38 tenants all paying the investment company rent, we then structured a management company, and so they would pay the management company, and the management company would just pay one rent to the investment company. And obviously the lenders like that more. It's less things to underwrite for them. It's okay, can you structure that lease in a way where it's, rather than having everyone on licenses, suddenly now you've got one lease paying you, I don't know, 80 grand a year for 10 years with no breaks and going upwards, only rent reviews and things like that. But we're still controlling those parts.
And the management company takes the little risk on there being leases and short term.
And at the end of the day, we own the management company too. So if anything happened to that, we can then create another one or structure it in a different way. So it's about
smart,
about understanding, I guess, how lenders and valuers look at it too. That's a big factor. But also, again, it comes down to how reliable is that income going to be from the view of the marketplace, because that's what, I don't know, your pension funds, a lot of your private equity will want to get into.
Do you, presumably you've brought investors in to acquire that?
That one we didn't. That one we kind of self-funded.
Okay.
But we got a good rate on the lending on it to purchase it, and we're currently going through a refinance at the moment. So
right, okay, it makes sense. So yeah,
we're able to. The great thing about that is we're able to service the costs kind of monthly as we go from the existing income, whilst increasing the income through kind of just, like you say, rolling
hands-on,
and getting into it. So it was great fun to kind of be involved in that project, because from a developer's point of view, the asset management is something that we don't get involved in that often. So it's always really interesting.
Unique.
Yeah, absolutely. Yeah. I mean, I've done smaller kind of versions of that in the past. With a hair salon, for example, where we did that, which is really interesting. It just goes back to kind of how you can create value on paper through kind of just restructuring leases and making that reliability of income for the future more secure.
Yeah. It's interesting. Yeah. In terms of, I just wanted to kind of segue into something, your podcast, the Rodcast.
Creative juices were flowing that day when we chose
the Rodcast. Yeah, it's great. No, but it was actually the first podcast I ever appeared in. So thank you for that, Rod. And you kind of introduced me to this market, and I've enjoyed it very much. But you've had a lot of guests on over the last couple of years, and first of all, I wanted to kind of understand what was your motivation in setting up the Rodcast.
So, look, I guess a bit of ego, if I'm completely honest. I probably like the sound of my own voice, as you might have guessed, me not being quiet. But it was really, I was having some fantastic conversations with some really, really interesting people that you didn't hear from a lot. And it was just through kind of work, through the stuff we were doing as an investment business and development business. And I was just in a really fortunate place to be able to be having these conversations. And then I would kind of go into forums and things like that, and you'd hear a totally different kind of almost property industry. And it was like, well, hold on a minute. This is kind of like the Tiger King of property. It's not real. And this is a real small proportion. And actually, the real industry is out there. And I wanted to bring that to the foreground, really, of what is going on behind the scenes, and some of these people that a lot of people probably would never have heard of in the industry that are doing fantastic things. And I just thought, there's got to be something in this. If I can record these conversations that we're having, one is going to keep me informed and up to date, which it absolutely has done, and that's been fantastic. But two, it also kind of forces me to continue having these conversations rather than me kind of just doing it as and when they pop up. It's okay, let's get some in the diary and what
got to be active, yeah,
and make it relevant as well. So I don't know, social housing is a big thing. So we did something with an impact investment fund recently, which was great. So and I learned huge amounts from it. So that was kind of the driver in it. I am the worst person when it comes to any form of tech setting it up, I had no clue. It was a nightmare. The first episode sounds like we recorded it in a bathroom together because we recorded it at the guy's boardroom on a glass table. And it's just this horrible echo, despite it actually being probably one of my favourite episodes. And yeah, so I thought, okay, let's do this, kind of getting out of my comfort zone and all that. And it's just been great fun. I mean, there's no.
It's very rewarding. I can speak from my own experience. All right, and I mean, one of the things that I wanted to ask you, because I've been sort of looking through. I've obviously listened to a number of your guests, and Adam being one that stands out. And I asked him to come on after I heard him on yours. But in terms of, you're at episode like 55 now by looking at the information here in front of me. I mean, tell us some of the more kind of the insights that have really kind of like changed your mindset and kind of opened your eyes a little bit, that you were living in a different world until you had that conversation.
Yeah, absolutely. So, I mean, one great one recently was with Ben Puddle, who he is the co-founder of a private equity firm that specializes in real estate. And something that he just said about kind of the management team being so much more important than almost everything else. And you hear a lot of cliches along the way, but this, like the way he drilled into it, just really brought home. He was like, you can be in a crappy market and still come out on top if you've got a good management team. But if you've got a crappy management team and you're in a good market, you're not gonna beat them out. And it was just like the way he put it. And I know their management team, and they are excellent. And they've done some absolutely phenomenal deals. And it just kind of drove home to me the importance of people, really, and their skill sets and kind of
A players, yeah,
absolutely. So that was great. And another one, like I said, the first episode, a guy called Jason Tracy, who owns a company called Beemore. Again, just an absolutely fascinating story of his career and kind of what happened. Again, apologies about the quality of sound if you do listen to it, but stick with it. It is a good one. And just understanding kind of a lot of it from lessons learned, what a lot of it was what's happened in 2008 to people. And we've interviewed a few people who really kind of got to breaking point on there. Another one was Paul Roshan, who did lose everything in 2008, and his story was just drives home how risky things can get when you kind of start taking things for granted in terms of the market and what you're doing, and it's hard not to do that when things are going well.
Yeah, I can speak from experience. Yeah, I mean,
exactly. Well,
you get complacent, and you kind of think. In my case, I can remember. I thought at one stage, I remember having Christmas dinner with some friends, and they were saying, "Okay, Gavin, because I was kind of always out doing stuff, and they're like, Gavin, what have you done today? Go on, tell us the news." And I was like, "Oh, I've just gone and borrowed, all these millions and whatever." And they're like, what would you do if you won the lottery in the morning? And I kind of said, I'd probably go out and like leverage it up 2 times and go again or whatever. And we were kind of joking about this, and I was really blasé about debt and about leverage. And I can remember kind of thinking that, I don't really give I couldn't care less about how much debt I have. It's just because I know I'll just make more money from it. And then, fast forward 5 years, and I was millions negative. And I can remember just thinking to myself, like, what planet was I living in that I was actually this blasé about having these huge obligations around my neck,
But I think, do you know what? And that's, I guess recently I've started to think about property in a slightly different way from a lot of these conversations that we had. And it's about understanding that kind of property, almost looking at it not as an asset class, but just as a vehicle for investing. And it's an amazing thing because unlike other asset classes, it acts as kind of you can make it act as long-term fixed income. You can make it act as a commodity in terms of its use and utility. You can make it act as private equity in terms of the equity that you're going in and leveraged up. And there's no kind of right or wrong way to do it. I mean, there is a few wrong ways, if we're honest, but there's no kind of right way to do it. It depends on what the investor wants. We've spoken to kind of real large institutional real estate funds that look at property now as a long-term fixed income. So they're looking at it and comparing it to other sources of income. They'll buy billions in cash, and they won't leverage at all, because their needs and their wants and their risk profile is very different because they're at that level. Whereas you talk to other individuals and a lot of people that invest directly in property and development, really they fall into that, rather than needing the fixed income part of a portfolio, they fall into that private equity part. And actually, which is fantastic, and you can make much bigger returns. But again, there's much risk to take. And that goes back to your thing of, I'd leverage it up. And look, we've all done it. We all talk about it. But it's understanding, I guess, from a personal point of view of where you are in your kind of investment career in terms of, I suppose it comes down to portfolio construction. What proportion of your portfolio do you want to act as equity? And out of that equity slice, how much of that equity do you want to be public, i.e. out in the marketplace? And do you want to be private, i.e. investing in your own developments, investing in your own portfolio, leveraging up to get maximum return? And how much do you want to be acting as that long-term fixed income? And at what risk? So that's kind of your buy-to-lets, your commercial portfolio, and what kind of risk level do you want on that? And I think it's really interesting when you start to break it down. And what you'll normally find is a lot of it depends on your age, how much wealth you've got to start with, what your portfolio is, kind of dependence, what your skill sets are, what your energy levels are like, because private equity does involve a lot of kind of energy and effort, as we've kind of discussed, and all these kind of other things, and also the values, because let's face it, if you've got, I don't know, 10 quid in the bank and you risk kind of what you're actually risking is losing 10 grand, but you are young, free, single, can go and get a job, then it's not going to take you a million years to kind of earn that back and be back to where you were. Whereas if you're risking 20 million pounds and you're getting on in life,
it's not so easy.
You're making that back. So I think the trap people fall into is they do really well when they're focusing their kind of investment focus on the private equity element of what they're trying to do. And again, you can bring it all back to property, but then their position changes, but they don't change their outlook in terms of how they want to construct their portfolio in terms of fixed income, risk, private equity, and to an element commodities as well. So I think that's an interesting point. But yeah, going back to your question about insights, that would probably be number one. Just understanding people's stories is just, I mean, it's always great. We do a bit of a mix of kind of content, like heavy content on certain specific things, such as, I don't know, supply chains, contracts for kind of development, things like that, right through to tax and structure. And then the other part is kind of listening to people's stories and learning from a lot of it from people's mistakes. And there's been some absolute brilliant ones in there from people from across the board, really. So
I'm going to put a link in the notes through to the Rodcast so that people can find it and give it a listen as well. Rod, I'm looking at the time there, just conscious of your time. Can you just one of the questions I like to ask my guests is, you're of a similar vintage to me now, and you've got a good few years under your belt. And looking back to when you first started out, like, what advice would you give to your 20-year-old self if you were?
I would say go and work in the industry for a bit to get an idea of how other operators do it. And then when you go on your own, or start to go on your own, you can do it on the side, but prove the concept, prove what you're doing works, okay, before you scale up. don't start scaling up, taking on leverage before you've proven that what you're trying to do is a viable investment. And like, for example, people like WeWork and things, all these people didn't do that. They didn't prove actually the model works, the model's financially viable. And you often find people are going into their next thing before they've, I don't know, exited one and proven it. And this time they're going to scale it up. And I just think that's very risky. So I'd say probably that would be the one thing.
Proof of concept. It's a good point, and it's funny. One of the things that I've heard people say, and it seems to be this kind of, I think people call it hustle porn or something like that, where there's this whole thing where guys are out there, oh yeah, I'm a serial entrepreneur. But serial entrepreneur means that you're doing things in tandem. You're trying to run 2 or 3 businesses in tandem. What you want to be is, you start a business, you sell, you exit, you make a ton of money, and then you start a new business instead of being sort of spread so thin across the board. And
definitely. I used to be a bit of a jack of all trades in property and sort of master of none, as they say. And I think absolutely there's a time where you've just got to focus and go all in. Thing and make it really good. And then I think people diversify way too early on the whole, or way too late.
It's the perfect point in time.
So I think that's a great point. Yeah, definitely.
Great. Well, Rod, it's been really great chat. I enjoyed very much. Can you just give us, if anyone wanted to reach out and find you, what's the best place to go and look for you?
Probably LinkedIn, Rod Turner. So yeah, get on there and have a look.
I'll put a link in the notes as well so people can find you and drop you a line or whatever. All right, Rod, great to see you, and talk to you again soon. Thank you for tuning in to another episode of Behind the Facade. If you enjoyed it or found it useful, please take a moment to leave a review over on iTunes, or indeed share it with a friend. This really helps the podcast grow and reach more people. If you have any questions, please connect with me via the Facebook group Behind the Facade Community. Alternatively, you will find me on social media under my handle Gavin J. Gallagher. And you can stay up to date with all the projects I am working on by joining my tribe. Do that by adding your name and email over on my website, gavinjgallagher.com. That's all for now. See you back here next week.